Welcome to the Tax Compass podcast, navigating UK tax for expats with LSR Partners. Right, so the budget happened.
Yes.
I was in the car on the M6 listening to it. It was a deeply distressing experience all ways round.
I was in a hotel room in Turkey listening to it on a phone.
All excitement. Look, I think one of the things that we can sort of take away from it was obviously a historic budget in the context of the amount of tax rises that were included. Now, clearly the big one that hit the headlines was the increase in employers' national insurance contributions, which, was argued was nothing to do with employees, but I think we can all see that that's probably not the case. Just talk to us a little bit from our client base perspective in terms of individuals. What were the key takeaways from that, and what do you think that means in terms of the direction of travel of like internationally mobile people?
So obviously there were the big changes in terms of the non-dom scheme, or the abolishment of the non-dom scheme, and the remittance basis, which is something that was mooted back in
a couple of years ago now, I think.
It's been talked about for a while. The Tories had suggested certain things were going to happen. The Labour Party's now gone and made some tweaks to that. So there is the foreign income and gain scheme, which is going to be available for the first 4 years of residence if you've been long-term non-resident, so non-resident for at least 10 years prior to your arrival in the UK. There's the temporary repatriation facility for people who have been taxed on the remittance basis, trying to encourage people to bring that money into the UK and spend it and boost the economy that way. And
what about in terms of actual tax rates? Because there was always the thing, wasn't there? They said, we're not going to change VAT, we're not going to change income tax, we're not going to change employee national insurance.
Yeah.
Capital gains?
So capital gains, effectively regular capital gains on shares, anything that wasn't kind of residential land and property has now been brought in line with residential land and property.
So we're talking changing from 10 and 20% to
18 and 24%.
So maybe not as bad. There was a lot of rumour, wasn't there, about they were going to harmonise it with income tax rates, and you could end up paying capital gains tax at your highest marginal rate of tax, so that could be up to 45%. So at least that didn't happen.
That didn't happen. They've kept the limit in terms of business asset disposal relief. There was suggestions that they'd be looking at getting rid of that in its entirety, which they haven't done.
But they are changing it though, aren't they, in terms of the tax rate that goes up to?
Yes.
I think it's 14% and then 16 or 18% as we go forward. We'll do another session on that because there are changes, but at least they didn't get rid of it altogether.
Yes, yeah, which is good, and that certainly from my experience the past few months, that has certainly been something that I've been speaking to a lot of people about who are basically planning on leaving the UK because of capital gains tax rates and capital gains tax rises that they were anticipating. But that change has already kind of come into play. So now that...
Yes, it's interesting, wasn't it? The capital gains tax rates changed for any transaction from the start of Wednesday, the 30th of October.
Yeah.
So unusual in some ways that it was an in-year random date tax rate change. I must admit, I thought they were going to change it as at the end of the year, the end of the tax year, to try and use it as a bit of a stick to get people to do capital gains transactions to actually increase the tax take. But maybe because the rates haven't gone up certainly as much as I thought they were figuring out, they just went for it straight away.
Yeah, I think that's probably the case.
And in terms of you mentioned there that like we've obviously had an uptick in our client activity in terms of people talking to us about, frankly, leaving the UK. Just talk to us a little bit about what some of the things are that people really need to be focused on in terms of wanting to leave the UK in the context of not then having to pay UK tax rates.
So I suppose a lot of people who are thinking of leaving the UK, they'll be thinking about leaving the UK for I suppose for the purposes of employment or self-employment income. They'll also be thinking about capital gains.
We've had a lot of clients, haven't we, who even before the budget have, and I suppose this is a reflection not only of maybe the UK weather, but also lifestyle. A lot of people. It's been a real trend of people talking to us about, actually, I can do my job remotely. There was obviously a big change due to COVID, right?
Yes.
That people, I remember. Right when I used to work in investment banking, there was always this idea that you can work from home, but everyone knew you couldn't really.
Yeah.
COVID really changed that, right? So a lot of employers now really do allow people to work from home, or frankly to work from the Costa del Sol or whatever.
Yeah. Well, during the pandemic, there were a lot of people who opted to go back to their home countries, who had been in the UK and working for UK employers. And up until that point, realistically, people who had maybe sent their employees outside of the UK, if they were UK employers, were large multinational companies. They were people who were being looked after by Big Four or kind of sizable accountancy firms. What we saw during the pandemic was people who were... just by kind of circumstance, they'd left the UK. All of a sudden, they had to be able to mobilise their workforce. The workforce kind of went, okay, actually, do you know what? If we're all going to die of COVID, I want to spend my last time with my family. And what they found was actually they quite liked it. They were enjoying working, and a lot of employers were kind of going, actually, we want to keep you, even though you want to be out there. And it certainly has changed the conversation. I find it's changed the conversation anyway, just in terms of employment and self-employment. But a lot of the conversations I found we've been having the past 6 months or so have actually been people who maybe through crypto investments, the crypto marketplace seems to be kind of shooting up again, and there's lots of gains to be realised in terms of crypto. And also people who are looking at shutting down their businesses, etc., who are going to be receiving large amounts of gains.
And that's definitely a theme, isn't it? I mean, we've seen it in the media in the context of I think there was a thing saying that like 9,000 millionaires were leaving the UK in the last tax year or whatever. And certainly we've had a lot of incoming from Dubai-based people or people who are thinking of going to Dubai. Yeah. There was an interesting, quite a long report in one of the Sunday papers a couple of weeks ago about people going to Dubai. Everything, as it said in this article, everything works. The lifestyle is very straightforward, and certainly my experience of having spent 5 years in Singapore, it really is. There are huge opportunities for people to go to more advantageous tax regimes. Yeah. Just in terms of that, though, in terms of your conversations with clients, what are some of the key things they need to be thinking about that can potentially trip them up in terms of making sure they do actually get out of the UK? Yeah. And I guess there's also some of that sort of temporary versus permanent stuff too.
Yeah, so I mean, the first thing that we have to consider if you're looking at leaving the UK is your UK tax residence position, and we use something called the Statutory residence test to determine that. You get some people who maybe say, I'm going to leave the UK for 12 months, but it doesn't coincide with the tax year. So you have to be out for at least a full tax year in order to be considered a UK tax non-resident. The Statutory residence test effectively is a series of tests to determine your UK tax residence position, and you can end up in a situation whereby if you don't follow the rules precisely, you can end up accidentally becoming considered UK tax resident. And, certainly in terms of...
Or not managing to break residence, I guess.
Yes, exactly. And in terms of the foreign income gain scheme, we can see that now actually the kind of domestic UK tax residence position, this statutory residence test actually is going to play more of a part for people who are leaving the UK. So the starting point is what's your UK tax residence position without considering what the tax position is in any other countries. You then need to think about what your tax position is in the country in which you're relocating to.
And just to interrupt there, I think that's a really important point that often can be confusing for the layman, is this idea that you can have a residency position which is entirely generated by the UK rules. You can have another residency position that's entirely generated by somebody else's rules.
Yeah.
And that's why you can end up in a situation where you can be tax resident in two places at the same time.
Yes. And I think as well, like, for example, if you were to go to Spain, they might look at the double tax treaty in terms of determining where you're tax resident or not, or which country you're tax resident in. But effectively, you're either going to be resident or not resident in Spain, whereas in the UK, you can be considered tax resident by means of the statutory residence test, but actually treaty resident in another country, and you can kind of look to that to provide certain elements of relief. There are certain reliefs available to people who are non-resident by means of the statutory residence test in terms of investment income and certain other like capital gains tax, etc. And then there's also kind of treaty relief available to people as well. So I suppose it's one of those where it's not necessarily the most straightforward in terms of figuring out what your position is, and it's realistically, especially if you're looking at leaving the UK because of taking advantage of certain tax regimes, you want to make sure that you are doing
getting the residency position right. To make sure you can get into the tax position you want to get into.
Exactly. And when it comes to the statutory residence test as well, it's very black and white. It's, have you spent a midnight in the UK? If you have, that's a day count. And once you've spent that day count,
you can't change it, right?
You can't go back and do it.
And we see clients, don't we, who quite often get into difficulties because they, as you say, irrespective of what they want their residency position to be, if they've had too many days here, then there's nothing you can do because it is a fact-based test.
Exactly.
And it's not an interpretive thing. It just is what it is.
Exactly. Especially, for example, if they've left the UK and gone on a special regime somewhere. So some of the like digital nomad visas that are available nowadays, you usually end up getting taxed equivalently like you're a non-resident, so you'd only be taxed on particular sources of income. Yeah. In those instances, the double tax treaty is neither use nor ornament to you. So there are various things that basically you have to plan, because if you don't plan, you're going to...
That's the key takeaway, isn't it? It's the time to have a conversation is before you do anything.
Yes.
And when I speak to clients and they say, well, I haven't done anything yet, but I'm thinking of X, Y, Z, I think always my first comment is, you've done exactly the right thing having this conversation now, because it's always frustrating for us, right, as tax advisors, when someone rings up and says, I've done all of these things, can you please tell me that I'm non-resident? No, I'm afraid you're not.
Yeah.
So it's difficult. And I guess moving it the other way round, we've said about the fact that, off the back of the budget, people are worried about tax levels, people are thinking about leaving, and there will be some people who will leave because they're looking really to optimise their tax position.
Yeah.
I guess the other side to it, of course, is that coming back to the COVID point, people are looking at things and saying, look, I can do it remotely. It rains the whole time in the UK. I'm going to go and live in Portugal or wherever it might be. And it's been interesting, hasn't it, that you mentioned the digital nomad visa thing. Spain have got a process. Italy have got a process. Malta, Portugal, they're all coming back with, taking advantage of this to get people into those countries.
Yes.
But I guess one of the things that I'm often fascinated by is the way that often we have clients who think that because they work for a UK employer, even if they go and live in Timbuktu, they'll still pay tax in the UK. Do you want to just run through actually why that's not the case?
So effectively, it's all about where income is considered to be sourced. So for example, if you have employment income, I'm going to say 9 times out of 10, because there are certain like crown employments, etc., that might remain subject to tax in the UK, even if you're working outside of the UK. But as a general rule of thumb, in terms of employment and to an extent self-employment income as well, that income is considered to be sourced to where you are physically located. When
it's all about exercise of employment, isn't it? Not who your employer is.
Yes, exactly. So I mean, that's a fairly common scenario that we get. I think I had one the other week where somebody had said, I'm effectively I'm taxable in the UK on this income, and it's like, well, no actually you're not.
And that comes as well, doesn't it, to that point where we've certainly had some clients who've come and said, I live and work in Spain, I work for a UK employer, they're deducting PAYE and I haven't done anything to claim it back, so I'm being taxed somewhere, surely that's okay.
Yeah, and no.
Exactly. and that's a real problem, right? Because I was talking to a client last week actually, and they were like, well, I'd rather just pay tax in the UK, but well, you can pay it, I suppose, but it doesn't change the fact that you're probably avoiding tax in the country where you're now resident. And it's important it's all very well saying, well, it all feels a bit difficult to get it sorted out. But we've also had clients, haven't we, who get investigated. Yeah. And they all say, oh, damn, I wish I'd done it correctly first time out, because tax investigations are never very pleasant.
I think the other thing as well to think about, because you get a lot of people who go, oh, well, how likely is it I'm actually going to get my money back? Well, HMRC want you to get your taxes right. Even if that means that they're receiving less of the money from you, like, they prefer that you get it right than wrong. Yeah,
that's a really important point, actually, because we often see that, don't we, with investigations, that people think that, they might end up in a jail cell or whatever. And it's like, one of the things that I find fascinating and frustrating, like HMRC, to deal with them is no one's idea of fun. But at the same time, it's very bureaucratic and it's a box ticking administrative process. And like even when it's investigations, it's like, here are the rules. And you know, our dear client in South Africa, who is, you know, including the HMRC person, sort of felt very sorry for her situation.
Yeah.
But they do take these are the rules, we just apply them.
Yeah.
And it's not up to us to decide whether or not you should or shouldn't pay tax. It's just the rules will say whether you should or shouldn't.
Yeah.
And if you've paid too much, we'll just give it back to you. And in fairness, their refund rates in terms of timing, certainly at the moment, it gets a bit difficult, doesn't it? After the deadline in sort of February, you can expect to wait a bit longer. But actually, we're seeing people getting refunds relatively quickly from submitting their tax returns.
As long as it falls within the system, yeah. I mean, there are certain instances when maybe people haven't notified HMRC that they intend to file, though they can kind of get stuck in the system. But as a general rule of thumb, the refunds are really quite fast.
And this links back again to sort of what to think about when you're leaving the UK. That whole point around tax returns in the year you leave is probably pretty important for people to understand, right?
Yes. So, I mean, for example, you might find that you get somebody who's actually planning on leaving the UK or leaves the UK with an intention to start with a new employer, but actually for a month or so they're actually still working for their old employer, kind of telling HMRC and making sure that you're claiming that refund in order to be able to pay tax in the country that you're relocating to. That's really important to do. You know, if you're not within the tax return system, if you're not, if there is no reason for you to file a tax return to let HMRC know. I mean, a lot of people aren't aware, but if you leave the UK midway through the year, because of the way that a payroll scheme works and the fact that for every month you get 1/12 of your personal allowance, 1/12 of your 20% tax bracket, 1/12 of any 40% tax bracket. If you leave midway through the year and you cease your employment before you leave the UK, you're going to
overpaid tax, effectively.
Exactly. So you can file forms called like Form P85s in order to let HMRC know that you've left the UK, and in order to claim that refund. A lot of people don't do that, and by the time they've left the UK, you know, usually if they haven't notified HMRC that they're leaving the UK, they haven't told them their new address, HMRC will generally write to them saying, oh, actually you've overpaid taxes at the end of the tax year. But by that point, it's kind of, you know, they don't get the post.
And I think the other interesting one on that, we had a client recently who relocated to Sweden, and one of the points that they just weren't aware of is that by not doing a tax return, because they left, let's call it after 7 months of the year, they were a UK tax resident for the whole year. They then went to Sweden and started working for a Swedish company, thought that was completely outside the scope of UK tax because, well, I'm sat in Sweden working for a Swedish company.
Yeah.
But of course, from HMRC's perspective, they're like, no, you're a full year tax resident. You're therefore taxable on your worldwide income and gains.
Yeah.
So the fact that you were doing that job in Sweden doesn't change the fact that as a UK tax resident for that year, the starting point is that's taxable in the UK.
Yeah.
And so often when we have people saying, oh, do I really need to worry about a refund? It's like, well, it's not so much about, yes, obviously it's good to get a refund, but making sure that HMRC are aware of what's going on is really important, because at least it means that in the future, you know that you're covered if they were to come back and say, well, hang on a minute, you were full year tax resident.
Yes.
But that said, I mean, we had another client, didn't we, recently, who was in a similar situation of having actually had their residency position done wrong. But HMRC were pretty good about us going back to them and saying, actually, this is actually what it was, and then they updated their records. Yeah. So these situations can always be worked out, I guess. But it's important for people to get ahead of it.
Yeah, exactly. It saves hassle if you do it on time, and it saves the risk of investigation. And once you're within an inquiry, these inquiries can take forever. They can take over excess of 12 months to get it all sorted.
And just in terms of that departure point, you mentioned crypto. We did a piece of work for a client who got some very significant crypto gains. Yeah, they were looking to go to Dubai, I think it was, in terms of a regime where there is no capital gains tax. One of the key things we had to get them fully up to speed with was the whole idea of temporary non-residence. You just want to run through how that works.
So in terms of temporary non-residence, I think basically it's an anti-avoidance measure. The whole idea is it's designed to prevent people from kind of going, well, I'm going to break residence for a year, I'm going to realise massive gain, and then I'm going to come back to the UK. I haven't really left the UK, but I've just done it to try and avoid paying taxes.
And just to be clear, this is the temporary non-resident stuff. That's just capital gains tax, right? It's nothing to do with income tax.
No, they can also kind of hit on a few bits of income tax. For example, significant distributions from close companies. For example, if you were to shut down a limited company, a UK limited company, you would either take it all as dividends, or you could take it as capital distribution. So if you were taking it as dividends, for example, and you that income was disregarded because you were non-resident for the year, then effectively that income could then fall back within the scope of UK taxation. So, I mean, the concept of temporary non-residence is if you've been a UK tax resident for at least 4 out of the previous 7 years prior to your departure from the UK, so effectively it's in your 5th year of residence that you would end up
falling inside of
that, then effectively you have to be a UK tax non-resident for at least 5 years, or not solely resident. So effectively treaty residents could come into play in order to kind of prevent that if you did end up accidentally spending a bit too much time in the UK, if it's available. But effectively you need to not be resident in the UK for at least 5 years. You have to go careful if there's split year treatment or if it's treaty relief, kind of
can make it a bit more complicated.
Yeah, in terms of when that 5-year period actually starts. But you have to make sure that you are out for the 5 years. If not, what will happen is any kind of gains that were associated with assets that you already held before your departure from the UK would come back within the scope of UK taxation at the point of repatriation. And potentially, so say for example you were outside of the UK for 3 years and you'd realised kind of potential gain, or you'd realise
the gain, but it's say in the first year of departure.
Yeah, that would fall within the scope of temporary non-residence. So you incurred over the 3 years, you repatriated at the end of the 3rd year, so you became resident in the 4th year. Then in that 4th year, all of those relevant gains would come back within the scope of taxation. You'd only have 1 year's worth of annual exemption. Not that the annual exemption is very much anymore.
But that's important, right? Because you'd be taxed at the rates and with the allowances in the year of taxation, not in the year of gain.
Yes. I mean, that's a pretty big thing, especially because at the moment, as we say, that there's no exit tax in the UK at the moment. So we do operate on an all or nothing kind of system in terms of capital gains tax.
But it's an important one, right? Because people do often think, well, I'll go out for a bit and then come back in.
Yes.
But yeah, that's not gonna work in terms of capital gains.
Or potentially, I mean, I spoke to somebody the other month who was looking at leaving the UK, the genuine intention to leave the UK, they're from Ireland. The intention is to relocate with their family to Ireland. They think it's going to be permanent, but there's always a possibility that their spouse might and their kids might not necessarily like it. So actually that they might return back, and talking them through obviously there's this opportunity for you before you whilst you're non-resident in the UK, non-resident in Ireland, there's a window of an opportunity. However, if it doesn't work out and you come back to the UK, you need to be aware that there's going to be a financial cost for you. And again, I think with everything, planning's only as good as if you actually plan it and if you have the conversations beforehand. So in that particular instance, they're aware that if they come back to the UK, there's going to be a tax cost, and then that allows them to make that decision about whether they come back or not. If things don't work out.
Yeah, so I guess that's sort of the summary, really, isn't it? Is if you are thinking of leaving the UK, obviously there are many more important things to be thinking about in terms of where you're going to go.
Yeah.
All of the admin. Having moved country myself, I can definitely say that moving country is a massive admin nightmare.
Yeah.
But the tax side of it is really important, and it is that whole thing about, for goodness sake, figure out what you're doing before you start doing stuff, because every day that goes by has potential tax consequences in the way that the UK resident system works.
Yes. And I was going to say, I suppose the one final point I would be making, if you are looking at leaving the UK, or if you are looking at breaking UK tax residence, keep a travel calendar, keep it up to date regularly, rather than trying to scrat around at the end of the tax year figuring out where I've been and
that's
what I've been doing.
Point.
Because from HMRC's perspective, if they ever were to inquire into your situation, they would want to see those records. They'd want to know that you know where you were, rather than
it's the beauty of your smartphone having geo data in your photos. So take lots of photos. I always recommend.
Nice idea.
Thanks for listening to the Tax Compass podcast, brought to you by LSR Partners, where we help you pay the right tax in the right place at the right time. Book a call with us. Details are in the show notes.